You've probably heard someone say whole life insurance is a ripoff, and someone else say, I wish I knew about it when I was younger. So, which is it? The truth is, both sides are right depending on how your policy is designed. Today, I'm going to show you two real examples, one designed in the agent's best interest and another designed in your best interest. You will immediately see why one feels like a scam and why the other can actually be a powerful financial tool. Whole life insurance is one of those topics people either love or hate. And honestly, I get it. Most of the horror stories comes from policies that follow what we call the traditional setup. It has high premiums and almost no cash value in the early years. But when it's structured properly, it can do the exact opposite. It can build cash value quickly and give you flexibility and grow predictably over time. Here's the part that most people don't know. When you put money into a whole life policy, it can go into one of two buckets. We have the base insurance, let's call it base, and then we have the paid up additions rider, or PUA for short. Okay. Now these buckets serve completely different purposes. So the base insurance, it covers the policy expenses, which includes agent's commission, and that's what buys you the death benefit protection. So if we look at it in terms of cash value and death benefit, then the base insurance, it starts off very low in cash value. So let's give it a 1 star here. But then it buys you more death benefit upfront. The 5 stars. But I want to point out over time, the cash value from the base insurance is going to grow. Okay. The PU, on the other hand, is sort of the opposite. Most of the money in PUA goes to become part of the cash value. So let's give it a 5 stars here. But then it buys you a little bit more in death benefit as well. So as you can tell, they serve different purposes, and depending on how an agent allocates your money between these two buckets, it can work out in your interest or against your interest. An agent not only has to know how to design these policies correctly, but they have to be willing to do it right. And this is where these products can get bad reputation, because sometimes people just don't do what is right. So I'm going to show you a couple of designs, one which is the traditional design, all base design, and then one that we have PUA blended in as well to make the whole thing more efficient. So let's take a look at those. All right, so this is the first design. It's for a 35-year-old male who wants to fund this policy, $10,000 a year, and we are funding it for 15 years. After that, no more funding. Usually you hear people say whole life insurance, which sounds like you have to pay it your whole life, but that's not the case. You have control on how long you can fund the policy. You can fund it sometimes in 5 years, 7 years, 10 years, I'm done. You're able to do that. Okay. So the question is, where is the money going? In this case, you can see that the whole $10,000 is allocated to the base insurance, which is called Whole Life 95 here. And that buys you $585,000 in death benefit here. Okay. Now let's look at what happens. We pay in $10,000 into the policy year one. The cash value is very small, just about $300 here. But you can see that over time, as you pay in, as we continue to pay in more money, more premium, your cash value continues to grow gradually. We want to know what we call a break even. That is when you have the same amount of money in cash value as you've paid into the policy. By year 10, we've paid in $100,000. We only have $93,000. So we are still not break even. We go to year 13, we've paid $130,000 into the policy. By then, we have $130,000 in cash value. So that's when we break even, 13 years, which is not the most efficient because most people are not waiting around for 13 years. And this is when sometimes people give up, they stop funding these policies and they can lapse and all those stuff coming, right? Because over time, we sort of forget why we got these products. And so we want to see these things do well upfront as quickly as possible, okay? So this is the traditional design, everything allocated to the base insurance. Now, let us look at a better design, which uses the PUA, okay? So I'm on this second design again. 35-year-old male, funding the policy $10,000 a year. Again, we are funding for 15 years and then no more funding. One thing you can see that this is a little different. We have the base insurance being very little here. We are dropping the base insurance, and you can see that that buys us $50,000 in base insurance. And then the rest of the money goes to what we call the paid up additions rider, or PUA, as we are talking about here. Now, I want to point out we spent $200 in term rider, and that term insurance buys us $449,000 in term insurance. Now, this is a cost-efficient way to increase the MEC limit, which allows us to contribute $10,000 into the policy. Now, what this means is that you need to have a certain amount of death benefit to be able to contribute the $10,000 into the policy. And the term insurance is very cheap. It's the cheap way to get to the death benefit we need to be able to put $10,000 a year into the policy. $10,000 goes into the policy. We have a little over $8,000 upfront in year one. So you see the difference quite drastic. And this is because we are using the paid up additions rider. If we go look between year 6 and 7, we break even, which is far better than 13 years. And from that point forward, the cash value continues to grow. Hey, if you are getting value out of this video, I will really appreciate it if you subscribe. I can see a lot of you watch my videos. Subscribe, become part of the family. Thank you. Now, one of the common arguments you hear agents make about the traditional setup is that it pays more in dividends. And that is true. So let's take a look at this. So we come back to the traditional setup here. And let's say by year 15, we are getting a dividend paid out of about $5,590. And when we compare it to the better design, the dividend for year 15 is $4,700. So you can see that the dividend in the better design is smaller. But the question is, how much cash value do you have in the policy? Are you more interested in the dividend, or you are interested in having a bigger cash value? When we take a look here, you can see that in the better design, we have cash value of $192,000 by year 15, right? $192,000, even though we got a smaller dividend of $4,700. Now, when we go to the traditional design, yes, you got a bigger dividend of $5,590, but the cash value is smaller. So you have to watch out for some of these arguments that people make. Are you interested in the bigger dividend, which gives you lower cash value overall? Or are you rather going to choose a design that may have a lower dividend, but gives you a higher cash value? That's a question that you have to answer. So watch out for some of these arguments. Make sure you are getting the full picture. And if these are some of the things you have questions about, put it in the comment section. Or maybe you want to talk to me one-on-one. You have some specific questions around whole life insurance. I'm going to put my contacts in the description below. Feel free to reach out to me. I can talk to you, understand your needs, and help you out. Thank you so much for your time here with me today. I really appreciate you. I'll see you again in the next video. Bye.